This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, March 31st, 2016. Euro dollar. So on a short-term basis, we've seen a nice recovery in the euro over the past several days, but on a medium-term basis, the pressure still remains on the downside. At this point, the market has stalled out just shy of the 2016 high from February at 113.77, and that's going to be the key level to watch above. Below, we need to focus on recent support at 111.45, with a break below that level to take the pressure off the top side and open the door for a resumption of declines. So right now, 113.77 and 111.45 are the key levels to watch above and below. Sterling dollar. So cable has stalled out into recent gains, with the market remaining under intense downside pressure on a medium-term basis and focused on additional weakness, potentially back below recent support at 140.53 and towards a retest of the recent 7-year low at 38.36 further down. At this point, any rally should continue to be well capped, while only back above 146.68, that high that we saw back on the 4th of February, would take the immediate pressure off the downside. Dollar yen. So dollar yen continues to consolidate off recent multi-month lows, and the consolidation is classified as a bearish consolidation while we trade below the 115 barrier. As such, any weakness that's seen below 110.67 could open the door for the next major downside extension and bearish continuation towards a measured move in the 107 to 108 area. At this point, again, only back above 115 would take the immediate pressure off the downside. Euro Swiss. So Euro Swiss continues to trade sideways for the moment, but the overall structure is constructive following that recovery out in 2015. At this point, any setbacks should continue to be very well supported into the 108 area, while a rally back above 110.24 will open the door for a retest of the multi-month high from this year, which came in at 112. Above 112 would then expose 115 further up. Again, only back below 107.15 would compromise the current recovery outlook for Euro Swiss. Aussie dollar. So Aussie has recently rallied up to a fresh 2016 high at 77.09 thus far, ahead of this latest minor pullback. Right now, there is risk for some form of exhaustion and a rolling over, but the market would need to take out 74.77 to confirm or strengthen this outlook and accelerate declines. A break back below 74.77 over the coming sessions would also set up the potential for a double top that would project setbacks back down towards the 72.50 to 73 area. Dollar CAD. So dollar CAD is now correcting off those recent highs, those 13-year highs from January at 146.90, with the correction extending to fresh 2016 lows at 129.12 thus far. This has been a 10% or plus 10% correction since January, and the market could soon be looking for some form of a base ahead of a bullish resumption of the more meaningful longer-term uptrend. At this point, if we see a break back above 132.96, that will do a good job of strengthening the recovery outlook in this market and opening the door for an acceleration of gains. 32.96 break would also set up a potential double bottom and open the door for an initial upside towards a measured move that could take us up all the way towards the 137 area. Kiwi dollar. So Kiwi has pulled back a little bit since posting fresh 2016 highs at 69.66. There's a lot of solid medium-term resistance up above and towards and into the 69 area, and so the market would need to establish back above 69 to really open the door for meaningful upside and take the pressure off the downside on a medium-term basis. At this point, key support comes in by the low that we had seen on Wednesday at 68.41, with a break below there to accelerate declines and strengthen the prospect for a resumption of declines. Ultimately, next key support comes in all the way at 65.46, below which would expose the 2016 low at 63.47. Again, only a meaningful close back above 69, perhaps on a weekly close basis, would put the pressure on the top side and can suggest a potential shift in the structure. SPX 500. So the S&P 500 has now extended its gains beyond 2050, which was that ideal lower top level. But again, on a weekly close basis, if the market holds back below 2050, there is still risk for a meaningful lower top ahead of a resumption of declines, eventually back down towards and below that recent multi-month low at 1808 from February. At this point, key support comes in at 2021, so a break below there will be required to strengthen this outlook, while again, really a weekly close back above 2050 or a break above 2100 would force a shift in this outlook, this newly adopted bearish outlook for the S&P 500, despite this impressive push off the February low. Gold. So gold has pulled back in recent trade, but ultimately, since breaking back above the 1190 area several weeks back, the market has seen a shift in the structure that now favors additional upside back towards a retest of the 2015 high from January of 2015 around 1307. At this point, any setback should be well supported towards 1190, with only a close back below that level to compromise the newly adopted constructive outlook for gold.